Everyone is here. Everyone is good. I don't know. Let me check. The pound. GBP/USD is still doing what we expect. What's happening here? Oh, that's just probably some news. If we open the calendar, probably we're gonna know why. Let me check. Yeah, that was the average earning costs. But that's not much. Let me check. Yeah, just now 6 o'clock. So we had on indexes, index plus bonus and climate count change, unemployment rate. Yeah, so everything came lower except the unemployment change and unemployment rate from October. So those three news here, basically, but that's strange. Probably won't suffer much because seems like that we did had a revised up from last date. So pretty much, you know, we did had these movements down, but this was revised up. So yeah, but yeah, it's going a bit down, but that's nothing. It's just like what, 20 pips. Anyways, guys, let's get it started. Let's go for the US dollar first. Ooh, what's happening here? Okay, so 4 hours. This week has a few interesting stuffs happening. All right. Today it won't be too long. I'm gonna try to keep it short because, you know, there's not much happening and we are very close to what is the most important event, and I want to talk about that. That is the FOMC, the Fed, the rates, right? Okay. So on Monday we didn't have anything, you know, too much, but on Tuesday we did had a few things interested here, just as now we did had for the pound. But then, you know, we won't have anything until, I don't know where you guys from, but for me until tomorrow, that it's actually in a few hours, that will be midnight 30. We're gonna have the core CPI for month over month, and we're gonna have CPI as well, year over year and month over month, for US. So that's going to be very, very important for the US dollar and how, you know, it will affect the trajectory for the US dollar. So let's say we're going to have, you know, much higher than expected reading here on the core CPI as well on the CPI. To be honest with you guys, you know, one of my friends, I was talking to him today, and he was like, most probably that we won't have any surprise. Yeah, so that's exactly Kawasi. Sorry if I pronounced your name wrongly. Hey Matthew, how are you, man? But you know, just because I was talking to him this afternoon, and we were looking at something very interesting here, that it's these two that I've showed you guys so many times, the CME Fed watch. And there's an option here that you can look at the dot plot, right? And if we click on the dot plot, it basically opens a chart with dot plots. And what does this mean? This basically shows us what the FOMC members are expecting towards 2023, 2024, 25, and the longer run. Okay. But if we look in the blue, let me grab my pen here so I can circle that. Do I have a little Okay, I do. So if we grab this blue here, it's what most matters to us. Okay, those blues here. Okay, and this one as well. So what basically does that mean is it shows us how the majority, or at least the most importance, expecting it to be in 2023, you know, in respective years here. So if we see here, that's 2023, that's then 24, 2025, and a longer run. What would be a longer run? That could be until 2020, until 2030, let's say, until 2027, 2028, or something like that. Okay, so here are the dates, pretty simple charts to understand, okay? But anyways, so if we take a closer look here, you know, of course, the Fed, it's most probably done. If we look to these 2023, most probability is at around 5.5, 5.75. Okay, nothing much above the 5.5. Okay, it's between 5.5, between 5.75. So if you pay attention, you know, you have 5.25, 5.5, and 5.75, and 6. So if we pay attention here, it's most probably that the Fed is actually following what they've said. Okay. And most probably we're going to have something. I'm not going to be too good on draw these, but I will try. Let's go for purple. Maybe pink. Let's go for pink. Okay, maybe if I use this one here would be better. Like that. So what we're gonna have, it's something similar like this, okay? And then yeah. Okay. Not too good on drawing, but hopefully you guys could understand. So basically we're gonna take where we are right now. Okay, where we are right now at 5.5, and we're gonna decrease next year in 2024 to around 5.75 to 4.75 to 4.5. Okay, that's the most probability. Okay, that's the highest probability that can happen. Now, the market is it's quite interesting what the market is doing right now. So the market is fighting the Fed more than ever before. Okay, so what does that mean? Well, basically the futures, the market future currently are expecting the Fed funds rate to finish 2024 around 4%. Okay, that is the majority of the non-players from Fed somewhere here. Okay, so we are expecting 4%. The market is expecting 4%. Meanwhile, the latest Fed dot plot, as we're just looking at now, shows FOMC members expect rate to finish 2024 around 5.1%. Okay, so every member, so just to make a comparison here, every member of the FOMC expect rates to finish 2024 higher than what the market is actually expecting. So to put in other words, every Fed member would have to be wrong for the market to be right. So fighting the Fed never works. So the market is expecting actually that the Fed will reduce more than what they are saying that they will reduce. So that makes me think one thing already. Okay, and now when answering your question, Kawesi, if the market is expecting the Fed to reduce more, then they're expecting that inflation will come will come lower, much higher than expected. Okay, but if the Fed saying that they won't, reduce as the market is expecting, then they may think inflation will stay higher for longer. So most probably what can happen is as expected or a little bit higher than expected inflation. Okay, why? Well, that's my first explanation. All right, second explanation would be the NFP. Quite interesting what the Fed is capable of doing, right, on those last few months, couple of months. Let's delete all of these here just for a second, and let me open NFP. What's the name of that website? Trading Economics. Okay. So here we can see by these. Oopsie, 1 year. Where's my tool again? Okay. So basically, what just happened here, right? January, we had a massive 472,000 addition of jobs, right? No one was expecting that much, but it did happen, right? 248 on January, February, March, April, June, August, June, July, September, October, November, December. So let's go here. Let's I don't want to do the math behind it, but let's say that it's somewhere between the round number. It's somewhere between those areas here. All right. So that's the round number. I mean is the average. Okay, the average would be somewhere around this black line that I've just put it there. Most of the releases were above 200. We only had, let's say this one is 200. Okay, let's say this one is 200. So 199. Let's call it 200. We only had 3 months lower than 200,000 addition of jobs. All right, only 3. Only. We just finished the year. Like for NFP, we won't have NFP anymore this year, only next year. But we did only had 3 months of, not even, we did have, I think the only negative one was on June. That was much lower than expected. Okay. So if you think about that, right, the Fed is actually controlling the inflation, because if we look at the inflation, right, what I want to show you this is how stable the job growth is. Okay. It is sort of stable. I'm not saying that it's completely stable, but see that every month they are adding another 200,000, except for 3 months. So that's if we do the math, if we take 100% divided by 12, it's going to give us 8.33%. If we time this by 9, is it 9? Only 3 months? Yeah. 9, we're going to have 75% of this year had an addition of 200,000 jobs every month. All right, 75% of the time of this year had an addition of 200,000, at least 200,000, counting with this one as well as 200. Anyways, so the logic behind this I want to show is we do have a sort of stable. Okay, keep this in mind. Next, if we go for the CPI, on the United States inflation rate, we look at here, look at how beautiful this is for this year. Okay. Is it so close for them to be able to actually tell the media that they did control the inflation? But now there's only one thing they need to bring down the rates as well. And this is the most crucial point. To be honest, it will be quite sure that the Fed will have a soft landing, okay? In terms of not destroying the whole economy and making kaboom everywhere. Anyways, so if we take here the thing again, where is it? Here, let's put it in purple. Let's get, sorry, this one. We start January here. So, we did have this one, and then we did a drop, and then we did a little bit more drop, and then we have a little bit more drop, and then we had a huge drop, and then we had a little increase, and then another little increase, and then another little sort of normal, and then another decrease. So we came back basically to July, okay? But look at how, I would say, good they're doing a job, all right? If you put in perspective, if you take UK, for instance, or if you take whatever, let's not talk about emerging markets. Okay, let's not talk about let's say Philippines or Brazil or and those things. Let's talk about G8 economies. So UK, Europe, Swiss. Swiss is impressive. We're not going to talk about Switzerland because they are awesome on what they do on controlling inflation. They've done such a good job on quantitative tightening. Man, I want to show you this later. The quantitative tightening they've done to reduce the money supply on the economy and actually appreciate the Swiss franc was so beautiful to see. If you really like economics, you know what I'm saying. Anyways, so about here again, we are stepping down every month, except from July to November. No, sorry, September. And now we're going to have November. So it feels, it feels like we're going to have something like similar or a little bit up. How can I change this? Okay, there we go. A little bit up. So then next year, we may start to bring inflation down again. Okay. This is my take. Okay, this is my take. So I do think we're going to have something similar because we just came back to the same level as we were in July. And what happened in July, went up. And basically what I'm predicting is that we stay the same or we do go a little bit up. Okay. Another thing, with a higher, consuming expenditure, that we're going to have the retail sales this how can I take this off? We're going to have the retail sales this week. So unfortunately, CPI will come first, but we're going to have retail sales on I think it's Thursday or maybe Friday. Interest rate projection. Am I misunderstood something here? No, I'm pretty sure I saw it. Retail sales, yeah, that's going to be on Friday. Retail sales, yeah, unfortunately, we're going to have retail sales only for only on Friday. So, if we have retail sales first before the CPI, that would be really, really good because, we could see how much people are spending. But I want to bring attention now to another thing. US credit card spending. I don't know if it's this one I want to show you guys. Food services, drinking. December 6th, spending on accommodation. Let me see if it's this one because I do have the thread as well I like to use, but no, it's not this one. We can go for this one. It's better. rate on credit card loans, consumer loans, commercial bank, no, net percentage of domestic banks signing. Where's credit cards? Rate on credit card loans, seasonally adjusted. Okay, that's 2022. That's too much. I just want 2023. Q3. Okay. Let's put in perspective here from first quarter 2023 all the way to now where we are. So this is pretty much the rate on the credit card loans. Okay, because for those who don't know, hopefully most of you guys know. A credit card, it's an instant loan. Okay, the way the credit card works is you have a limit or you don't. You know, it just depends what credit card you have. So I do have a credit card. I do use it. I do make use of that. But bear in mind that, you know, having a credit card is it damages your score. So if you have a bad credit background, you know, if you're not paying your credit or you're not, you know, knowing how to use it, or you letting to pay after it closes or something like that, always try to pay on date. All right, just a little financial sort of aspect here for your personal finance. Anyways, so if we start here on Q3 2023, Q1, sorry, 2023. So here, it was in 2.43%. Okay, and right now is on 2.98%. So basically, we did, of course, had an increase of pretty much 0.65. So we did had an increase of 0.65% on the credit cards. And, you know, this is showing me that people are not stopping to spend. So if they keep spending, inflation will keep higher, okay? And of course, the Fed, you know, most probably will need to keep a hawkish approach to the monetary policy. So if he keeps you know, if he comes in with a neutral, I'm not saying hawkish like, oh, we're going to raise. No, sorry. Sorry. I misunderstood. That we need to keep a neutral to hawkish approach to the monetary policy. They can't be, you know, totally hawkish, or they can't be totally dovish. Otherwise, you know, the futures markets will price in something completely crazy. Anyways, so coming back now, it was just something I want to show you guys. Coming back now to the US dollar. So what most probably will happen is, you know, even if, you know, we have a, I would say, much higher than expected, of course, the US dollar will feel it. But I do believe that we're gonna still have a little bit of decline until if we can't break this top here on the US dollar index. What's here? 104.2. If we still, you know, trading below that level, most probably we will still be a little bit dovish or a little bit bearish. And if we break those lows, of course, we're going to go, you know, lower and lower. Now, just want to bring attention for the gold. Well, you know, we were right. We were discussing this trade last Tuesday. Yeah, it was last Tuesday. It was a very nice trade. You know, as I've mentioned, we did had a breakout of those lows. We did return it here, and that was our first target. Remember, you know, for those who were here, you probably do remember. I'm just give a sip of my water. You do probably remember that I've said, you know, we're going to have this 2030 here as our first target, and afterwards we see what we do. Well, there you go. First target hit it. Second target was hit it as well. I think I've took it off, but it was here. And now, someone mentioned on last week that we would have a target somewhere here. I don't know. I just feel that it's too much of a drop. But I still holding my short positions since I do have a few short positions here, and I do have a few short positions somewhere here as well. Okay, I'm still holding it towards the CPI and towards the FOMC this week. Okay, so you guys have your own strategy. Just bear in mind that this is no financial advisor or nothing like that. I'm just expressing my view here. But we do, gold tends to be a good safe haven in the end of the year. But seems like with all of these things that are happening on the Middle East as well now with, on Red Sea, we won't have that rally that we used to have, because if we go for a daily time frame here, most of December months we'd have, so that's 2023, that's October, November, December here. So we always have, not always, but most of the time we have this rally. Okay, let me show you another one, 2022, November, December. So we do have a little rally on December, and it goes and keep going to November, November, December. So here we do have a little rally as well again. So most of the times gold do those rallies on the end of the year, but we did hit an all-time high again on gold, all right, for that was the second time. So for a second time we did hit all-time high. And if we look what happens when gold hits all-time highs, basically it drops. Okay, so I just took advantage of that and placed a short position here, and now I just added another short position here. Yes, that's the thing, Santi. Gold usually does this rally, but feels like it's not going to happen this December. We are already in the middle of December, and it didn't happen yet. If it happens, that's good, but most probably that we may see a decline on gold for those levels somewhere around here. Okay, for the level of 1950. That's just my personal take, so just bear in mind. Okay, guys. Now, just let's go for a quick one on US 10 years and US 2 years. They did felt, this whole massive drop. Of course, it is influencing the weakness of the US dollar. So keep an eye on those guys. And let's talk a little bit about euro dollar now. That's 4 hours chart. Okay, so we still have a little bit to go here. When was last Tuesday? What day was last Tuesday? Let me check on my calendar here. Last Tuesday, so that's this Tuesday here. So Tuesday, Friday, Thursday, Wednesday, Tuesday. Okay, so on here, exactly on this one, last Tuesday, exactly on this purple line here, is when we had our webinar last week. And I've mentioned that I do have a target at 107. Okay, so let me put it 107. Okay, 107 would be my first target, and then we see how we go. Even Lawrence, wasn't you, Lawrence? I think it was you, right, mate? That was mentioned about Goldman Sachs, JP Morgan. Yeah, it was you. About one parity, 104 parity, something like that. Anyway, so it is happening. The trade is happening. Okay, bit low than expected, but it is breaking lower lows. So it's making lower lows. We did have this breakout here. We just need to check if it's going to break this high. If it breaks this high, then most likely it will continue to trend up. Just remember to watch the CPI. CPI If CPI comes higher than expected, that it's what I'm expecting, then we may have a further decline on here. So this may be a good time, that I would be looking to position a few more short positions for my portfolio. That's my trade. You guys, have your own strategy. You guys can trade your strategy, okay? Just bear in mind that this is my type of trading. Anyways, so, if it comes somewhere around these areas here, I would be looking to add a few shorts until here, 107, okay? Only if CPI comes as expected or not. But the main reason why the euro dollar had this 2% drop here from the top, to here, so 2.67%. Let me take this off just a second. All right. Did this 2.6% drop was because a dovish approach from ECB. Second, CPI lower than expected. All right, so let's have a look on Europe CPI. Euro area consumer price index. That's not what I want. I want the inflation rate. It's not what I want. Sorry, guys, just a second. Inflation rate. This one. One year. Okay, cool. All right, let's go for the boring stuffs again. Here. All right, January. And now, November. Oopsie. What? What's happening? Oh, okay. So January to November. Look at this. We only had one month that was higher than the previous month, and that month was in April, and it was only by 0.1%. Okay, so ECB is doing a great job as well. Okay, and they are very, very close to control inflation by 0.4%, and this has a dovish approach to the market. Okay, of course, has a dovish approach to the market because no one wants to put euros. No one wants euros anymore. Everyone wants dollars instead because, now comes a part who's going to cut first and how much they will cut next year. If Fed cuts more, I don't want my money in US. I want my money somewhere else. That won't be, one cut. Anyways, so we did start at 8.6. We went to 8.5. We went to 6.7, and we did a little 0.1% up, then 6.1, and then 5.5, and then 5.3, and then 5.2, and it just keeps going down. 4.3, 1% drop at 0.9, actually 2.9, and then 2.4, and we can even go for a little bit lower. Okay, so just bear in mind, this is the main reason the market is pricing inflation already sort of gone on US. Okay, right, guys, just a second, just let me drink my water here. Okay, sorry. It's very, very hot here. Right, so that's another another reason why the market is pricing a bearish euro. So if we look at the market, sorry, let me take this off. If we look at the euro, it's just what is happening. Okay, so market pricing a little bit more of a bearish side, a little bit more of a dovish side from ECB, pricing a little bit more of a good, let's say hawkish, not too hawkish, but bullish US dollar. And voila, there you have it. Now, another interesting trade that I'm in. All right, you guys may be like, oh my God, you're really into this? You want to, what are you doing? I know, I've been judged already today because I'm on this trade, so don't judge me. I'm short Euro JPY. Yes, I'm exposed to JPY. I am exposed to JPY, okay? And it's working. So the main reason why I'm short on here is I just want to have a more exposure on short euros. But I don't want to short, let's say Euro CHF, or let's say Euro GBP or something like that. I want to have exposure to Japanese yen, because I've heard a phrase today that was so cool. I've heard a phrase that then we are the same. I'm short KJPY. Well, there you have it. How's your trade going? Yeah, you're good. Yeah, that's good. If I know you, you probably just entered somewhere here, right? Anyways. So coming back, Euro JPY. I've heard a phrase. I want to show this to you guys later. Just let me grab this already. But I was reading MUFG reports today, and first reason why I'm short on Euro JPY is because they are short on Euro JPY as well. But second reason is because they've mentioned something kind of cool. They say JPY is one of those pairs that go up by escalator and go down by jumping from the building. So you know what I mean? It takes ever for JPY to goes up, but once he goes down, it's the opposite. When JPY goes down, it takes the lift, but when it goes up, it just flies. So basically what they mean is when JPY wants to get stronger, it just gets stronger really quick and really fast. And this is pretty much what you can see. Every time JPY gets strong, this is what happened. So I'm just counting on this strength. But we did even we did have I wouldn't call it a mark manipulation from the board, okay? But they were a bit tricky there, okay? So let me show the bonds here, right? Pretty quick. So this movement here on the Japanese 10-year bonds was on last Thursday when USD JPY dropped a lot. And the main reason, actually a good hedge to have on this Euro JPY would be long USD JPY. But a main reason why did this happen is because Weather came into the media and he expressed that, I've mentioned this on my YouTube video, but I'm going to mention this again here. He mentioned that there's a possibility that December meeting would, this was last Thursday, would be possibly some changes. All right. In other words, was this. It wasn't specifically this, but the market understood on this way. And then he comes into the media, I think it was yesterday, Monday, but was on Sunday in Japan, or Monday, something like that. He says, well, we're not going to change in December. And then the market just dropped on here. Okay, so is he playing around with Japanese yen? Is he playing around with the bond market? I don't know. I can't tell it. Credit Agricole is short on Euro JPY as well, also USD JPY. Also another institution having the same positions, but yen is tricky at the moment, to be honest. Yeah, it is tricky. That's exactly what I'm mentioning. It's a tricky pair. But anyways, I'm short on Euro JPY. Okay, that's my trade, personal trade. So don't follow me. Okay. Anyways, let me try to search pretty quick here for you guys. I just want to show you something. That's not what I want. Is it this one? Daily snapshot? I think it's this one. Okay. I just need to click somewhere here. Yes. and then I need to click on here, and then I need to open it. Okay, there we go. So if we scroll down over to the bottom here, new trade idea, short Euro JPY, open at 155.35, targeting 149, and a stop loss on 158.8. And they say here, go up the escalator and down the lift shaft. So that's a nice phrase, okay? We don't expect the board to hike on 19th of December, but those expectations should persist next week, so this week basically. Or Euro JPY stop is just above the high from yesterday, so that was on Thursday. Anyways, so that's the main reason why I'm on short Euro JPY as well. Okay. Now I want to show you, just to finish it up and to wrap up. Let's go GBP USD pretty quick. Of course, same as last week, I'm still expecting a bit of a decline here. Now, if we look at the economic calendar, we see that we're going to have a few important news for the pound on Wednesday. Starting with the GDP, the gross domestic product. Seems like it's gonna, decrease a little bit to negative 0.1%. If it comes lower than expected, most probably will. Okay. And then after that, we have as well on Friday or Thursday. Yeah, Thursday, we're gonna have the interest rate decision. Of course, I can't say of course because I'm affirming, but anyways, it's most probably will be at 5.25%. They won't change it, or there's no need for them to change it right now. Inflation is reducing. Just no need for that. And then we're gonna have on Friday, where is it? Here, the manufacturing PMIs. Okay, for the UK. And then that would be it. I think most of those data will sound dovish to the market, bearish to the market. Okay, so just bear in mind, that we just broke this area. So market may be coming to retest, and then most probably something like this, and it'll come to this area. All right, that's my take on GBP USD 1.24. Yeah, 124. 124 sounds good for now. USD JPY. Yep, USD JPY. That was the reason that I've mentioned for you guys on Thursday, that I've showed this up move on the Japanese and Japanese 10-year bonds. But yeah, that's pretty much it from currency pairs, and this is pretty much what I'm feeling like it is sort of popping up some opportunities there. Now I want to show the commitments of traders, and so we can wrap up. Everyone good? Any questions, please? Oh, good. Okay, that's good. Right, so let me zoom in. One more. Okay, cool. Let me grab this. Yeah. Right, US dollar first. Look at these. Look at these. Look at that. Okay. So we came from October, mid of October, from 5.7% all the way to now, December, to 39%. So we went from 5.7 all the way to 39%. Now you tell me, are they building positions for next year, or are they closing positions? Okay. If we look at this side here, they are slowly building short positions, slowly, okay, slowly. But for that, these numbers are high because, all right, so I'm going to try to explain this in a very simple way. The net percentage is the long plus the short divided by 2. Okay, so whatever happens on long and whatever happens on short doesn't matter. It matters what happened on both together, combine it and then divided by and then multiply by 100, and then this will have our net percentage. So can you see that on 17th of October, the first one on the bottom, we did had 30 long positions and we only had 17 short positions. So pretty much they had 80% more than 80% more long positions than short positions. But then on one above that, on 24th October, we did had 29 long positions, but then we had 12 short positions. Okay, and then counting 27 and then 30 and then 27, 24, 22, 23. So we went from 30 to 23 long positions. So we reduced 7 long positions, but we didn't open 7 short positions. All right, we only opened 3 short positions. So this doesn't matter because it's sort of equilibrating. So they're getting off from the long positions, okay, but they're not adding short positions. So this 39%, it feels like inflated, but it's not actually 39% because we only have 23%, 23 long positions and 20 short positions. So the portfolio, it's quite hedged. It's quite break even. We only have 3 more long positions than short. Okay, so just bear in mind. Don't watch those big numbers and think, oh my God, like what's happening? All right, so just so you guys know, hopefully you could understand that. Now, going for Canadian dollar, okay, not much happening here. Okay, we went from negative 18% from 24th of October to negative 19%. They are holding lots of short positions here and increasing lots of long positions. Okay, Japanese yen. Japanese yen is kind of similar. It haven't changed much. Well, we did have 9% here negative, but if we look at the long and short positions, they are kind of similar, so you haven't had much difference. Does anyone have a question? Someone raised a hand. If you can, you can just type on the chat and yeah, I can answer you. Thank you. Now moving to New Zealand dollar. We are negative 15 and we were negative 8. So yeah, a bit of more short being added on the market over there. Okay. Now moving to the other side. See, moving to the other side, we have CHF. So if we look at on the top here, CHF. And we haven't had much, but we did had a flip on this, and feels like we are having. Let me change the color. Let's go for this one. No, not this one. Blue. Okay, and it feels like we are having a sort of a persistent, continuously adding short positions on there. Okay, so from what day was that? 7th of November. to 5 of December, we did had a flip and an increase on net percentage negative. So let's have a look on CHF from 7th 11. 7th 11. Let me close this. Let me take this just a second. USD CHF. Okay. 7-11. 7-11. Was it 7-11? Was that 7-11? Yes, 7-11. 7 October, November. 7 here. Okay. So from there to now, you know, we've just looked at the COT for the US dollar, oopsie, and we had much more increases on positions since the 7, that is on this one here. So from 16 we add for 15 and 19 and then 32 and 39, and here we had a flip to negative, and this is a trade. I've teach you guys this is strategy, and you know, if you just come here and you see it's working. So we did had a negative CHF. So CHF is basically should be declining. Sorry. Yeah. Anyways, so we are having a, let's see, CHF JPY. Here is CHF. Here is CHF. CHF as well. Aussie CHF. Yeah, Aussie CHF did worked pretty good. Anyways, so just watch out, okay? Feels like CHF is not that strong anymore, as you know, leverage funds are looking to short it. Euro, well, not much to talk here, to be honest. You know, this is a novel, just doesn't go anywhere. They just seems like they don't want euro on the portfolio, and this makes me think, okay, so that's a good opportunity to short it, all right, because it's not going anywhere. And pound didn't happen much as well. We went from 1.4 to 6.7, but it's still pretty much similar here on long and short positions. All right, now just looking up at the seasonality, just a quick look. Right, we are having that euro rally, so that's the thing. CHF, we are definitely having this rally on CHF, but yeah, most probably, you know, JPY will strengthen a little bit, and then afterwards will decline. New Zealand dollar will decline, Aussie dollar will decline in strength, GBP will strengthen, and US dollar will decline. But look, this is, you know, it's just seasonality, so it's not 100% accurate, but it's good for you to have a look on those types of things. All right, so that's pretty much it, guys. That's all from me today. Just, you know, again, euro dollar probably around 107, GBP USD probably going, you know, to retest and then coming to 124, 160, and then we have gold, most probably coming to retest somewhere this area and then coming back to this area. And we have as well dollar, yep, index, dollar indices. If it breaks up here, then yeah, good. Otherwise we are keep going down. All right, guys, so that's all from me today. Hopefully I could help everyone. Does anyone have a question or anything? Feel like I covered pretty much everything, right? All good? Okay. I'm gonna send the Telegram link. So if you're not there yet, please make No, it's all right, mate. Not a problem. So if you're not there yet, please, just access it. Completely free. Very good. So you guys can, here it is, Telegram link. Sending it now. Please, guys, join there. As soon as we hit 100 subscribers, we're going to have a very nice webinar only for, those people who's there. Okay. Awesome. Thanks, Y. Thanks, Matthew. Thanks, Tom. Thanks, Isengu. Thanks, Kwesi. Thanks, Alex. Thanks, Lawrence. Thanks, everyone. Have all a good trading week ahead. And please, anything, just let me know, and I will happily help you guys. Okay. All right, guys. See you in the next Tuesday.